Good morning and welcome to the Wilson County Library Seminar, Lesson 9, Part 2 of 3. My name is CATHELYN Griffin, and today I am interviewing Mr. Roy Idrach, who has been the seminar facilitator for the last 3 years at the Wilson County Library. Mr. Idrach's career in trading goes back to 1972. That's about 48 years of experience in stocks and commodities trading. Mr. Idrach owns and manages a private investment fund. We want to give the most sincere thanks to all the participants who submitted questions for this interview. We received hundreds of them, but due to the time limit, we are going to cover as many as possible. And now we would like to welcome Mr. Roy Idrach.
Thank you, man. Thank you. It's a pleasure to be here today, and I'm very pleased that you're inviting me to this interview. So I guess we'll go ahead and start. Do you have any questions for me today?
Yes, sir. How are you doing this morning, Mr. Idrach?
Oh, I'm doing okay. It's been a long journey, 48 years of this business.
Wow, that's a long time.
Yeah.
So tell us a little bit about yourself and how did you get started into stocks and commodities trading?
Well, I started back in 1972 when I was about 32 years old. What really happened was that I didn't know any better, like most stocks investors do, and the broker kind of took advantage of me. So I had to get a job to keep on working and survive. The guy who was making rich, the representative from the broker company, and I never made any money. Eventually, I learned how to get around those things and learn, and then here I am today.
Wow, Mr. Idrach, sounds like you have lived a very exciting life. As you know, we have some questions. Our first question is from a student in Houston, Texas, and they want to know why long-term investing beats short-term investing.
Right. Short-term investing, you don't give enough time to the stock to actually gain the proper value where they can benefit and profit. So when you do short-term investing, or it's more like a trading and you're actually gambling. The long-term investor is totally different because the long-term investor, you take, for example, Shopify. Shopify 5 years ago, you have put $5,000 into it, you will have today about $700,000. If you have invested $50,000, you will have $3.5 million. So long-term, years into it, is more productive than short-term.
Oh, wow, that's very valuable information, Mr. Idrach. Now, what is your opinion on long-term investors and day trading? And what do you think about employers' retirement accounts for their employees, like their 401ks and so on?
Okay, this is a very kind of complex situation, Okay. So we're going to divide it into two parts. The long-term investor do better in the long run. One of the reasons is that the compound effect of their investment. The investment, as it grows, they pay dividends, and all that it multiplies its value, they can be reinvested. A long-term investor can invest on an index fund, and the compounding effect of the index fund has a multiple return through the years. You also can add more money monthly to the index fund, and therefore at the time compound all the interest, earning on interest and dividends. Eventually in a long term you can have millions of dollars invested.
Oh wow, I never realized the impact of how our life, how much it costs us. I have a text question for you from someone that is watching our interview live, and this person would like to know, what is selling short and how does it affect the price of the assets or stocks?
Okay, let me go back a little bit in regard to the retirement account. On the retirement account, you got a situation where they got multiple ways of doing it. This is the second part of that. For example, you pay into the plan and your employer might or might not contribute to your retirement. You take like federal employees, you get a different retirement that teachers have and municipal have. But all of them have one thing in common. They got management fees. And those management fees are very dangerous because people don't realize what happened. Some of them charge 1%, some of them charge less, but you gotta realize that you're putting 100% of the money into it. You're taking 100% of the risk into it. They just manage the fund, so they don't have no risk at all, but they charge a fee of 1% per year, or 0.75, 0.75%. The thing is that you take somebody that put 40 years into the career and put them to contribute into the investment for the retirement account, they take in 1% a year. So you multiply 40 years at 1%, you put 100% of the money, but you only get 60% back because you have been killed by the 1% that is charged every year. So by the time you retirement, you only get 60% of what you invested. And I don't think that's right. Now, going back to the selling short is a very tricky situation. When you sell short, it's meaning that you're selling something that you really don't own. And here's the part. The brokers say, well, I'm borrowing the stock from the broker in order to do this. Well, how do we know even the stockbroker have the stock? The part of selling short is that one of the first things that happen is that you're taking a lot of risk. If the short seller, the price continue going up, you have to make up all the losses. And that could be very risky because it's unlimited losses. And these losses can take you to a margin call, meaning that the broker is going to call you and say, hey, we need cash money here right away. And it can be very large amount of money. And now you find yourself selling your home and your children in order to pay the broker.
Yes.
That's one of them. The other part is that on this type of trade, you gotta understand the factors that are involved. One of them is that when you sell something short, it counts as a selling stock. As the price drop and you buy, it counts as buying stock. So when you sell short, too many people sell short, what it does is that it drives the price down automatically. So it's all depends. So you sell short and not too many people are traders and selling a short, they are buying. Now they drive the price up and this is where you get the margin call. So it affects both ways. When you sell a short, it's supposed to drive the price down. It all depends how many. When you buy it back, it comes as the price goes up. Like if you're buying or you're actually canceling the order. And of course, you see the price goes up and you say, oh, the market is going up, the price is going up. But it's going up, the price is going up because what? Somebody's selling or somebody's buying, or is really the short seller buying the stock back to take the profit. So we have to interpret what's going on, or else you jump in and thinking, look, it's going up. And then by tomorrow, 2 days later, there's no more short buyer and the price collapse. So you go in at the timing, at the wrong time, you can lose a lot of money.
Okay. I'll bet very few people realize how the inside working of the markets functions. Can you give us an example of a stock order flow and free commission?
Right. The stock order flow is very interesting because what happened is that you take somebody like Robinhood. Robinhood was the first company that started a non-commission business. You know, now everybody do non-commission. But Robinhood really what they do is they pass through the order to somebody like Citadel or some other broker, and then the settlement of the price of the stock, they get a commission off of that. So they're not really free. It just sounds like it's free, but they're not. They say no commission, and what happened is that the market makers take, for example, the stock is I buy, right? And he might buy at a lower price than the stock really is. So then again, there's another spread. So let's say, for example, that I order 1,000 shares, and it used to be that we pay $5 for 1,000 shares. Then the price of the stock was more fair, and therefore it might be just 2 or 3 cents different between the price and the actual price. Now, when we put 50 cents or we put 25 cents into in 1,000 shares, now the market maker is making $500 on 1,000 shares, when before they used to get only $5. So it's a better deal for them, but not for the actual retail trade. Especially a mutual fund will be treated different because the large amount of volume that they buy millions and billions of shares, so they get treated different. The little guy is the one that gets hurt. So there's no free lunch on this business.
Well, very interesting. So we pay one way or another.
That's exactly right. we pay one way and another.
Okay, we do have a question about what is the 90-90-90 rule, and can you explain it?
Yeah, 90-90 rules is very interesting. For example, what happened with the 90-90 rule is that the short-term retail trader investor, it gets short-changed out of his money. They go and open an account, they put $500, $300, $5,000 or whatever, and brokers know already. You go on TV and you see this advertising every evening from different company advertising to open an account. Why do you think they're doing that? The reason they're doing that is because they are replacing the account that went broke or they cannot trade because they don't have the money. So they know already for a fact that they have to spend 60% of the money to bring new traders into the floor because they depend from them. Mm-hmm. So if they go broke, he don't trade anymore. He don't buy or sell. So how are they going to make a living? Those guys need to get paid. Advertising has to get paid. Building renter has to get paid. So it's not free. So what happened here that they already call it a rule 90-90-90 rule because 90% of the investors lose 90% of the money in 90 days. 3 months later, they're broke or they don't have enough money to trade. Some of them close the account and therefore they have to advertise to get new business. So the 90-90 rule works every time. One of the reasons is that we have high-speed traders in the business. And the high-speed trader is companies or individuals that put a computer very close to the exchange, and that computer works in millions of a second. So they can see the trade. When I put a trade here in Floresville or on my office, by the time it gets to New York, that computer already saw my order. That's another problem, a handicap for the little guy. So they go ahead and buy, if they got the computer buy it in a millionth of a second, by the time my order reached the exchange computer, they had it for sale at 10 or 50 cents more. So this allowed them, some of the hedge fund managers use this, like Mr. Ray Dalio, and they allow them to make, he makes about $1.2 million an hour because of this. When everybody else, they don't even make $1 million in a lifetime. So there's some handicap when we get into this business that people need to be aware of it, that they don't realize it and nobody talk about it. But I've been long time involved in this that I know better. This is what's going on. And hopefully the help those viewers or this Q&A with what's going on.
Oh my goodness. Well, yeah, so lack of understanding and emotions must be a very important or play a very important issue on the failure or success of this business.
Yep.
And we have another question from a Facebook follower for you, Mr. Idrach, and this person would like to know, what is cattle mentality?
Cattle mentality has to do with safety. For those of you that know about cattle, cattle can be peacefully grazing on the ranch with no problem. But if they notice something wrong or they get spooked, even if it's just the bird making noise, one of them start running and all of them run. They all follow through. They ask questions later. We as a human being have the same thing. Nobody want to lose money. The stock market, the price start going down, and one guy said a large order, and everybody else starts selling. So we got kind of mentality into the stock market. Now, what happened is that this kind of mentality is what gets us into all kind of problem, you know, because let's say, for example, that I give you an example, like I'm gonna give you a job and this job pay $1,000 a day for 31 days. So I'm gonna give you a choice of how you wanna get paid. So you say, okay, $1,000 a day sounds very good, Roy said, but I got you another one. I'll pay you a penny a day and I double it every day for 31 days. So here comes the safety effect of the cattle mentality. It's easy to figure out $1,000 a day for 31 days, just 31,000. But mentally calculating 1 penny a day, doubling every day is a different story. So we want to play it safe. I don't know the unknown. I don't know where the noise came from, but I just ran. So I said, should I take the penny a day? Some people are going to say, oh, well, I know the answer. Well, you know the answer is obvious that, but this is not what is involved on this question. And this question is the compounding effect of the penny a day and the compounding effect of $1,000 a day. Every day we doubling our money 100% because if today they give me $1,000, tomorrow they have to give me $2,000. 3, 4, 5, 6, 30,000 a day in a month. The penny is a little bit different because they say we're going to double it every day. So on the first day you get a penny, but tomorrow we're going to give you 2, so now you got 3. Next time we're going to have to give you 4, but you got 7. So by the time you do over 7 days, you only get about $3. And you say, oh my goodness, 2 weeks already, $3, this is bad news. So if you can't manage that far, you turn around and say, I take the 30,000. In reality is, we're going to see on a video that we're going to add after this question into the tape, is that those pennies a day, when you double it every day for 31 days, comes up to $5 million. That's one way to calculate that. If they just figure it straight, if you add the other 2 pennies, then it comes out about $10 million in 30 days. But because we don't know the unknown and we don't have no crystal ball, we try to be safe. And this is what happened with these day traders. They want to say, oh, I make $500 today, but I realize that if I hold the stock for 5 years, they will have made $3 million. So they will know nobody have, there's no such things as gurus.
Perfect. Well, that's very interesting information. So as humans, we tend to want to play it safe.
Yeah.
So Roy, what about assets allocation to return investment? What is your thoughts on this topic?
Well, allocation on investment, it has a lot to do with age, you know. It's all depending if you want to be conservative about it. And when we do that, and how much risk. So for example, if you want to take a mid risk, you can invest about 49% of the money that you have in domestic stock and 21% in foreign stock and 30% on bond and 1% on cash term investment like CD, 90 days CDs, stuff like that. But age has a lot to do. If you start working at 25, you're planning to retire at 60 or 65, then you can take more risk and add a stock on more risky stuff on it, because if something goes wrong, you got time in order to recover. So that's one of those things. Now, you take a guy like me, that I'm 80 years old, I don't have much time to recover anything, something goes wrong. So I cannot be investing on risky stuff. I will have to be investing in something more secure. This is one of the things that have to do with it. So some very conservative investment include 49% on bonds, but bonds pay very little interest. They put just 20% now into domestic stock. So it's changed from 40 or 30 or 49 to 20. And you adjust those things according to the people's age. But some people don't even think about that. They want the money now. I want to spend it now, I want to make it now, and this is where they get hurt.
Very true. And here we have another good question for you. There are many opinions about this subject. So what do you think about stock splits and reverse splits?
That's very crazy. A stock split, it has to do with a company giving the perception to the investor that they're getting something for nothing. Because if they say, we're going to give you 3 shares for every one that you have. You say, oh, wow, I'm going to have 4 shares. And it didn't cost me anything. But here's the big question. Do the company worth more because they issue 3 more shares? Is I got $1,000 in a stock here, and I'm going to issue 3 more stocks for every page that we got here. How much does it work? If it's 1,000, it's going to remain 1,000. What we're going to do is delete the value of it, because now is if the share were $100 a share, now 3 to 1, what you're going to do is that it's still $1,000 divided by what? $25 a share. You don't, so the stock will have to go up from 25 in order for you to do some money. But by doing that, they don't have to give no dividend to the stockholders. So it's a way of making it look like you're getting something for nothing, and you take time before you make any. On the other side, there are people that say, oh, no, you got it all run. He allowed other people to buy the stock at a lower price, but now they can afford it at $25. Well, that's not really true. That's an old idea, and people still got it on their brain. They get brainwashed into stuff and it's hard. But think about this. Now we can buy fractional shares. So if I only had $25, I don't have to pay $100 for a share. I buy $25 worth of that company that was 100. It's the same thing that you split it 4 to 1. I'm going to get a percentage base of what go out based on my $25 investment. So fractional shares now that they are allowed to buy, you can buy $100 of Facebook, or you can buy $10 on Facebook. Facebook got 20%, the $10 goes 20%. The guy that had $300 share, where he's going to get 20% based on the 300. He's going to get 60, you might only get 60 cents, he gets $60. But it's the same. Okay. So fractional shares and a split. Now you have the reverse split. That's another problem, right? A corporation like General Electric recently, they've been for several years, and I lost some money with them, where they've been at $5, $6 a share. So the new management comes in and they got a reverse split. And the stock was like at $10 a share, so they reversed it 10 to 1. So they took 10 shares out and give you 1 now. So now your share was, it still was $100. It didn't change anything. Now you got a $100 share instead of having 10 at $10. Nothing has changed. Well, the reason they do that is because if the company stock price is below $5 a share for a long period of time, you get delisted from the stock exchange. And then you cannot see the price anymore because they just put it with the junk stuff. So if they couldn't buy the stock before, they don't even know what is listed now because it gets removed from the exchange. So you won't be able to track the price of how it's doing. So this is one way to legally prop up the value of something that you remove a whole lot of it, and that way for more. So I got $100 and I got $100 bill, and I say I'm going to make 100 to 1. Then I'm going to have $100 bill when before I have $101 bill. But I don't have no more money. It's still the same. Mm-hmm. And people kind of fail to realize that.
Oh, wow. Well, now, Mr. Idrach, many people think that the options are risky and complex. Can you explain to the viewers how stock options work? For example, cover call options?
Right. Option can be simple or can be complicated. They have two names of them. And the two names is a call and the other one is a put. So it's actually a contract that derives for something that is real. So we got a contract here and we say, okay, we're gonna do an option on, let's say, IBM. This is not the stock, we're just gonna write a derivative. The option value derived from how IBM is performing. So we enter a contract that I say, well, I'm gonna buy one contract that it comes with 100 shares at $5. So I pay $500 for a call, meaning that I expect the price to go up. So now, in a way, I got control of 100 shares of IBM, but if IBM is $100, and I don't have $10,000 to buy IBM. So now allow me to enjoy the price move for a fraction of it, $500. What happened with option is that they have expiration date. So if I buy an option for $5, they're going to expire in a week. At the end of the week, if the price haven't gone in my favor, that money is gone. The guy that owns the stock is still have it. Now, when the contract means that you got the option to buy the stock, to sell it at a profit, but you don't have the obligation to buy it. So if you don't want to buy it, you don't have to buy it. You sell the contract, it's over and done. If the price of IBM is $100 a share, you expect it to be 105 in a week, and you only get to $102, you just lost the $500 and that's it. You know, the guy that bought the stock at $105, now it dropped to 102, he will lose $300. But options have that risk involved, and they're more complex of them. Some of them, they call them a strangle put. So basically, we write a lot of options. We buy the stock and we write the option because this is actually generate revenue for us. We very seldom buy option. We rather sell it, collect the money next day, and see how things happen. So it helps us reduce the risk. We got on YouTube channel, you know, we got many videos and we're going to put it below this.
Options are contracts between a buyer and a seller and may help you achieve a variety of financial goals. There are two types of option contracts, calls and puts. Each call or put generally represents 100 shares of an underlying stock. So, the listed price of the option should be multiplied by 100 to arrive at the sale price before commission. A call gives you the right to buy the underlying security at a specific price for a specified time. A put gives you the right to sell the underlying security at a specific price for a specified time. There are 5 important components to an option. First is the underlying security. This is the stock or asset the contract represents the right to buy or sell. Second is the expiration date. This is the specified time when the option contract will expire. The strike price is the third component. This is the price at which you agree to buy or sell the underlying security. Fourth is the option type, call or put. Finally, the premium is the price you pay for a contract. Remember, this is multiplied by 100 to get the total cost of the option contract before commission. When trading options, you can buy or sell to open a call or put position. When you have an open option position, you are then able to buy or sell to close the option position and exit the contract. Options are either in the money or out of the money. How is this defined? Calls are in the money when the price of the underlying security is trading above the strike price. They are out of the money when the underlying security is trading below the strike price. Conversely, puts are in the money when the price of the underlying security is trading below the option strike price. They are out of the money when the underlying security is trading above the strike price. Option buyers can exercise and option sellers are assigned based on whether the options are in the money. The buyer of an option is purchasing the right to buy or sell the underlying security at the strike price until expiration. The seller of the option is obligated to buy or deliver the underlying security at the strike price. When you buy an option, you have three choices after you purchase it. First, because options are liquid assets, you can close out the position by selling the contract in the open market. Secondly, you could also exercise the contract. If you elect to exercise your in-the-money call option contract, you'd buy the underlying security at the strike price. If you elect to exercise your in-the-money put option contract, you deliver the underlying security at the strike price. Finally, you can let the contract expire if it is out of the money. Then, the option will be worthless at expiration, and you'd lose the total premium you paid for the option. You also have three potential outcomes when you sell your options, but you can only control two of them. First, you can buy back the contract to close out your position. The second choice is you can allow the contract to expire if it is out of the money. This allows you to keep the entire premium you collected. Finally, the outcome which you can't control is if the option is assigned to you. An option seller is assigned when the option buyer exercises his option when it's in the money. If assigned, you must buy or sell the underlying security at the strike price. For information on why and when trading options might make sense for your portfolio, click on the Why and When section in this module. To learn how to trade options, click the How-To section in this module.
Wow, so the option subject can not only be complex, but expensive. And here's another question about options for you. Can you explain the options bid and ask price?
Right. This is where the market maker decide based on the volatility of the stock, how much he's going to ask for the price and how much he's willing to sell for. See, this is how the market maker works into it. We got an intensive information in a video about those things that we're going to add to this question and answer as we go through here. So they're going to be more.
Let's talk about the bid and the ask and the bid-ask spread. Basically, the bid is what you are trying to get the order at. If I'm looking to buy Nike, let's say 100 shares, I'm bidding $50.90, but the asking price might be $50.98. For me to get that order, I'm gonna have to pay $50.98. Now, granted, stocks are constantly shifting and changing every second of every moment. But in reality, if I'm looking to buy Nike, I'm gonna have to pay the asking price, not the bidding price, okay? And if they're looking to sell Nike instantly and immediately, they're gonna have to be paying that bidding price. Now, the spread of that basically is the difference. So it's 50.98 minus 50.90, and that's 8 cents, okay? That 8 cents is what the market makers or the people on the trading floor get paid to execute that order. So it's the difference. So the minute you purchase that stock, you're gonna be losing 8 cents, because if you wanted to sell it immediately and they're bidding 50.90, you're gonna have to sell it at 50.90 and you lose 8 cents per share. Multiply that times 1,000, it starts adding up. So here's the issue or the problem that comes with buying and selling instantly and immediately. You can't really do it because it's going to cost you a lot of money to do that. You can't just flip on a dime, and that's short-term trading. But the bid-ask spread is the difference between the two, and it's what the market makers have to make. The bid is basically what people are looking to purchase it at. The ask is what people are looking to get for that stock. And the bid-ask spread is the difference. It's what the market makers make. Now, you can split that and maybe do like a limit order, which we'll get into another section, at 50.94. in order to kind of split the order and both of you take a little bit of a hit, you know, and kind of negotiate in the middle. But in reality, bid-ask spread is what you're going to pay, and it's just part of the trading game, I guess you could say, and you have to take that into account when you're trading. So keep that in mind when trading in understanding the bid-ask spread.
This question is one of the most requested. Can you describe a conservative stock portfolio?
Okay. A conservative stock portfolio is based that you're going to buy stocks on companies like AT&T, IBM, solid companies that have been around for a long time. They pay a good dividend. You take like AT&T, they call it the stock for the poor people. Take for example, orphanage. They are limited on where they can invest the money to take care of those children, and therefore their financial advisor recommend AT&T. The reason is that AT&T for years had paid 50 cents a share every 90 days. We take, for example, the other one that is very interesting is the stock from Coca-Cola. Coca-Cola pays 50 cents every 90 days. Mr. Warren Buffett invested in Coca-Cola for many years, and he owned 400 million shares of Coca-Cola. So just imagine that you get 50 cents times 400 million, you know, they're getting a good chunk of money every 90 days. Why sell it? They don't care where the price goes. So he's very conservative. He don't even use a cell phone, and he don't own a computer. He's like me, an old timer.
Well, that's very good information. I need to see how mine are doing.
Yeah, how your retirement doing,
Yes,
right?
how my retirement is doing. How do you select stocks, Mr. Idrach?
Oh, the selection of stock is very difficult, right? Everybody got an idea, but that don't mean that it's going to work. Everybody say this is best stock. What I normally used to do before now we have service that we subscribe to, that somebody else do the research for us. But not everybody is on that position because they charge a lot of money for that. So I used to look at the news and see the stocks that goes the most down on the streaming prices in there, and I write it down, and then I go and look to see how they're doing. Tomorrow I see them again and say, you know what? It's going through there many times. You know, I call this the poor man stock selection guide because you see it so many times going through there, so it's because they're active. So as I see the price goes up, well, let me do some research, a little bit of what I can do because I don't have the money to pay for the other one, and buy this stock. You got to remember that when you watch those TV programs, they sell an advertisement. So you got to be careful when these people start talking about this is a good stock and stuff like that, because you don't know who's behind it. Sometimes they do an interview of a company because the company is paying them to be interviewed. You know, this is how they generate their money. They're not going to tell you that. So the guy's not going to talk back about his company. He's going to talk, oh, we're doing great, we're doing this. They start acting like politicians. So this is one way. Until you reach a level that you can afford subscribe service that they do the research for you, it's very difficult to select the stock.
Okay.
Yeah.
Well, we have a very interesting question now about credit cards. So recently a viewer sent in saying, I received a $10,000 bonus at work, and I would like to know if I should use that money to pay off my credit card balance, or should I use those $10,000 to invest in the stock market and then gradually pay my credit card balance with the profits that I make from my investments?
Well, let me say never, never, never take this opportunity to go and buy stock. Because remember the 90-90 rule, you might lose 90% of the money in 90 days. And the credit card is going to still there waiting for you for payment. The best thing to do is to pay off those credit cards. Because now you, by paying this credit card, you have saved 28%. They charge between 25 and 28%. So the fact that you have $10,000 in credit card, that's $2,800 a year that you're paying in interest. In 3 years, you have paid $10,000 in interest of what you got now, and you never get out of it. So you have the opportunity to start on a clean slate. The best thing to do, pay the balance off. You just made $2,800, 28% just by paying the credit card off. You will make on one day 28% on the stock market. Not everybody can. So it'd be the best thing is to pay it off, and then you save some money and invest it, but you don't have this weight over you or the liability of $10,000 that is killing you at 28%. You taking 28% of the $10,000. You know, in 2 years, you already have paid them $5,000 in interest, and you're probably still in the hole by $7,000. So no.
That's very true. And now to change the subject, what do you think about the Federal Reserve Bank?
Oh, this is a very interesting story. You know, the Federal Reserve Bank is something else. We have to go back to the times, probably 1600, when the Jewish people that lived in Italy, in Venice, they are not welcome into town. And the Catholic Church, any Christian of the Catholic Church or that follow Jesus, he didn't supposed to, but at that time the Catholic Church was the most everybody was Catholic then. Even today in Mexico, about 90% of the population in Mexico is Catholic. So the church said you cannot charge interest to your fellow man. So just imagine what happened to businesses. You need to buy inventory, you need to do that, and you don't have the money. You cannot go to the bank or borrow it because they will say, no. And if you are Catholic, you better don't charge him because you're doing the wrong thing. Well, the only thing they had for as a choice was to go and talk to the Jewish guy. They don't have to abide for those rules. So they were put, when you walk into town, they make you wear a tag or something showing you are a Jewish person and you have to live on the slums of Venice. The businessmen go at night when most people are sleeping and knock on the doors of the Jewish guy. And when they open the door for you, they will set it in a bench. And the language at that time, the Italian name for a bench is banca. This is where the name bank comes from. So they tell us, look, I need money because I want to go to India and buy some spices, this and that. He said, okay, we charge you, but we need somebody that's signed for you. We need collateral. Do you have a friend that is well-meaning, meaning you got money to guarantee that if something happened to that trip, the boat or the storm wipe out everything, this person will pay for it, and then lend the money based on that. Here comes the Rothschild family now. The Rothschild family, 4 of that family became Pope. And one of those decided that, you know what? It's okay if we charge interest to somebody. And they developed that. Through the years, they start controlling the banking system, and they develop a double thing that is called you create money out of thin air. In the 1900s, United States saw how the Bank of England worked, that it was based on the principle of Rothschild, and we duplicated that. The Federal Reserve was created by Congress, but it was created as a private corporation. They don't answer to the government. They are not part of the government. Only the president can select a director to run the show. Congress votes for him, but the president or Congress cannot fire him. The only people that can fire him are the members of the board, that they are the other banks, and there are 12 branches in the nation. So what they do is that they conduct what is called fractional banking. Fractional banking has to do that you go to the bank and deposit $1,000. The bank give you credit for the $1,000 and you feel that it's safe. However, they're going to pay you 0.25%. So now they take $1,000 and the Federal Reserve say, for example, yeah, you can keep 10% of the money and you can lend the other 90%. So they put credit you account for $100 and they put now you a debit for $900 and they can go and now lend the $900 to somebody else. By the time you do this 10 times, they have created $10,000 out of 1,000. So you go to the bank, you put $1,000. I go to another bank or to the same bank and borrow $1,000. So they put out from somebody else the 100. They give me the $1,000, or they lend me the 900, and I go to my bank and deposit it. This bank do the same thing. Now they put $90 into credit to my account, debit the difference, and lend the rest to somebody else. So by the time the whole money is used, it's about $10,000 created. There's no more money, it's just created. So when people say that the government is printing money, that the government is doing this, that's not true. Money is created locally. When you go and borrow money from your credit union where you live, or you borrow from the bank, that interest that they charge you, it creates more money. But here's the catch. They're paying the depositor 0.25%, and they charge you 6 and 4% in interest. So they're making 4.5% on money that it come out of thin air. So that's actually how the banking system works. And we can put it, we got a link on this subject too, where you can see how the Federal Reserve borrow for the sake of time and explanation.
Wow, very interesting information. And so our banking system is not a part of the government. It's actually a private corporation with
Right.
their stockholders.
Right.
I'll need to see that video too. And those watching the program at home can see it too. You'll just scroll down to the description below where, like Mr. Idrach said, there will be the link attached. What do you think about artificial intelligence and metaverse?
Okay, this is something that is new. It's coming up. Very few people know about it or understand what's happening. But you take people like Amazon, General Motors, Google, NASA, Facebook, Apple are working on this. And the way it's done is very interesting, and they get it very close to it. Amazon want to create movement and robot that look like human and behave like human to move the packages around on the planet, because they can save a lot of money on injuries from humans. So the idea is to transfer the knowledge of somebody's brain into a machine via electron. And what happens is that our body and our brain works on low voltage electricity, very low voltage. This is how they can do a cardiogram in your body, because there's an electrical impulse that tells how your body is doing. So they go in a step much further. We're going to go in and go into your brain in a way that we can extract your intelligence and put them in this machine. They'll be able to know already what you need to do where the parts comes in, and then the human being is taken out of the picture. It will save a lot of money because they can work 24 hours a day. You don't have to pay workman compensation. You don't have to pay salaries. You don't have to pay union dues. You don't have to pay increase, health insurance. All that goes out of the window. So it's a new thing coming. On the other side, NASA would like to use that in order to send robots to other planets where they don't have to worry about food, they don't have to worry about dying, they don't have to worry about explosion, and they will behave just like human and bring information, and they can also perform jobs of cultivating or doing stuff that normally the human person do. Facebook and Google have a different idea about that. What they want to do is a three-dimensional image, and they already got very close to this. It's amazing. You can buy a frame. It looks like it coming from those space travel deal, where you can transmit your body. It's just an image, it's not your body, in reality, an image that represents inside of the frame, that it looks three-dimensional, it talks to you, answers to you, but the person is miles away. But this thing got memory and answer that is embedded into this particular case. So if your parents want to see you, you put the box on the house and you walk in, you flash into this deal just like YouTube now and have a conversation, but now you look three-dimensional. It said that they try to hug you or something, their hand goes into nothing. They stand back and here you are. You know, it's really amazing. But most of it is for creation of a new industry. We can eliminate that. Apple, what I want to do is put that also, this kind of science, into an automobile that will self-drive himself and recognize who even is the owner of the car. So there's an opportunity for investing on those things, but they're 10, 15 years away. It's probably before my time, before CDs.
Well, that's very interesting. So that'll be coming up in the next couple of years here. We do also have a question for you, Mr. Idrach. It has to do with cryptocurrency. And what are your thoughts on cryptocurrency?
Well, what we're going to get in cryptocurrency, there are too many. This is like the dot-com era on the 1990s. Everybody has a website, everybody going to make money, and eventually very few people survive. So in currency, we got billions of dollars invested in different currencies, but eventually when it becomes a threat to the government, currency system and banking system, the politicians going to come in and put laws and regulations that will eliminate a lot of things. They're going to be heavily regulated. Right now, they steal your account and they take $3 million of your account. There's no way to find out where that money went. You just lost it. And it's challenging our banking system. And they're not going to get away with this thing and keep on going like that because they want to be on that game of lending. And now all of a sudden, you can pay your relatives, sending some money. They don't have to pay anything. You don't have to pay the fee or nothing. So it's taken away from them. That's one of them. Another one, there was a time where money was nothing but little pebbles. And because somebody has faith on that, they bought and sold. No different than what we do now with money. We get a $20 bill, go to grocery store, and we pay for it, and they give us the grocery. But in reality, it's a piece of paper. So crypto is no different. They got faith on that, it works, and it put in a dent into the banking system worldwide. China is getting very touchy about that lately, and they're doing a lot of damage around to eliminate that. They just don't like that kind of stuff. And you can become bigger than the government. So they're not too happy about those things.
Of course not.
No.
Not in China.
No.
Our next question, they would like to know, how do you describe stock valuation and return on investment?
Valuation of the stock is based on the money that they made, the money that they paid out, and the price of the stock. The price could be overpriced. One of the best ways to do that is that they got a beta formula, it's called beta, and what they do is use the number 1 in the process. So anytime you look at stock price and you see that the beta there is 1.3, that means that if the market move 100 points, your stock will move in either direction, 1.3. If you see 1.5, that means that if the market moves 100 points, your stock might go down 1.5% more or 1.5% higher than what the market moves. So this is one number they use. We're also going to provide a video attached to this film where it's all explaining how the valuation is done. And there are different countries.
The capital asset pricing model, or the CAPM, estimates the expected return of an asset based on the systematic risk of the asset's return. While it has several drawbacks, it is an easy and effective starting point for estimating expected returns from an investment. Here's a step-by-step method to use the CAPM to estimate the expected return of Apple stock. The CAPM formula is this. The asset's expected return equals the sum of the risk-free return and the market risk premium, multiplied by beta of the asset. Beta reflects an asset's systematic risk. It would be too expensive and time-consuming to build a portfolio that includes the entire market. Therefore, we'll use the S&P 500 as a proxy. To estimate Apple's beta, divide the covariance of Apple and the S&P returns to get a historical beta of 1.26. That figure is then adjusted to account for ex-ante calculations, thus equaling 1.18. Normally, the 10-year U.S. government bond provides a proxy for a risk-free interest rate, and the S&P 500 is a good proxy for the expected market return. We calculate it as the arithmetic mean of monthly returns and multiply it by 12, which equals an annual 5.6% return. We can plug the data into the equation to estimate the expected return on Apple as 6.25%.
Rate of return is the earnings an asset generates in excess of its initial cost. The amount is usually expressed as an annualized percentage rate. Rate of return can be calculated based on the cash flows generated by the asset. In addition, it can include a capital gain element. Finally, the rate of return can be negative when the asset produces less income than its cost. The formula for calculating the rate of return over a single period is rate of return equal final asset value minus initial asset value divided by initial asset value. Rate of return is used to compare similar assets to determine which asset is the better investment. A rate of return can be measured for any type of asset, including marketable securities, real estate, and collectibles such as fine art and jewelry. For instance, Kendall buys a duplex for $100,000. She lives in one side and rents the other side for $400 a month. At the end of 12 months, she sells the duplex for $120,000. The initial value is $100,000. The final value is equal to the $120,000 sales price plus $400 monthly rent Kendall received for 12 months. $400 times 12 equal $4,800. Therefore, the total final value is $124,800. Kendall's rate of return on her duplex investment is 24.8%.
So basically dividing the net profit by the investment net cost, we get our return on investment.
Right, and there's several formulas on that.
Okay. Another question is asking why day trading is so difficult.
Day trading is difficult for the simple reason of the time. It's a very short time. And the price of the stock can move fractions of the penny in matters of seconds. So you cannot estimate what's going to happen next. A lot of people think they do. And this is why most of the day traders go broke, because they write today and they write tomorrow and then they become addicted. So they want to trade every day. And when they do that, they get in there and say, oh, I make $1,000 yesterday in 2 hours. So I go today, probably going to try 2 times as much. And what happened is that they don't know that short sellers over there selling the stock short overnight, and what you make now disappear. Either more short seller gets in, or they're bad news that has not come into the public yet, but there are people in the know that know about this news. They start selling ahead of you. And you walk in there one morning, the classic example happened this last Friday. A company from, it's a company that do technology and microchips. Well, when China start hitting all these other companies, the microchip that they're going to take them out of the United States and put them in Hong Kong, all those microchip people, they just took the kind of mentality and start selling. And if you was in the morning, there was company that were going up about $2 or $3, and just about 30 minutes into the stock market, the Nasdaq sold off, and most of the companies on the Nasdaq, and it dropped 500 points, and all those things just went down to 20% down and stuff like that. And if you get caught of some of this on day trading, it's over. But now you have to, and what happened is, let's say you lose 50% of the money, you know, and people say, well, I have to go up 50%. That's not true. You don't go up 50%. You lose 50% of your money. Your stock or your investment has to go up 100%, from 50 to 100 is 100%. So therefore, what happened is that to recover from the 50%, there's like I had $50, and now I need to be back to 100 to lose the $50 that I lost. You got to go up from 50 to 100, so you have to double. And that is not easy, and most of the traders don't have the stomach when you look in there, and you react too quick because your emotion, you cannot have emotion in your trading, and emotion is one of the biggest problems to control, because I have made no mistake too.
Oh, yes, so those emotions, got to keep them in check.
Yeah.
So as you're saying, day trading can be a very stressful and an unprofitable investment. And this brings us to the next question. Why is it that the majority of people can't seem to get ahead?
One of the reasons that people cannot get ahead, it has to do with the way that we're raised. We're raised in a way that my father goes to work every day. My mother stay home and take care of us. So by the time I become of age of working, so I figured that's the way I'm supposed to do. You go and work for pay. But here what happened? We have a situation where we got 24 hours a day. And 8 hours we spend it working, and we spend 8 hours probably sleeping, not including your travel time. So now you maybe have 6 hours left out of the day to do other things. So it's very, very difficult for you to get ahead. So there are other things that are some of the factors that include inflation. You get paid, but inflation eat away 3% of the money you make. The other one is taxes. You go to work and you get taxed. You've been penalized for being productive. Then the government comes in, you need a car, you get the sales tax. You go to the same place, another fee. Then you get deduction from your work. So in reality, what happened, then you got the bad habit that we learn from our parents, that you go to work, and so you never think that that's the right thing to do. And then we see people that the parents tell you need to get an education, and they do, but they go to work. And then here comes somebody that drop out of school and he become millionaire selling tacos. He make a restaurant, he became famous. He said, my goodness, what is it here? Some of them are mechanics, and they say now the salary for mechanic pay more than a professional salary, for professional. So then there's another part involved in this, and this discrimination. You can be discriminated in a way that it prevents you from getting ahead. It's not your fault. The system is worked in a way that it don't let you get ahead. You take, for example, in Texas, in the 60s, all the universities were in Austin. And the only university in San Antonio, for example, were private schools like St. Mary's and Trinity. And the average worker could not send his kids over there. So without saying that we're discriminating, the workforce on the west side, that the majority were Hispanic, they didn't have a chance. So it brings this problem that to go to a state university, like the University of Texas, now you're going to go and live in Austin. But your parents, the parents of this kid might not have the money to pay for shelter, food, and tuition, so therefore they cannot progress even though they were very sharp. So it's overlooked, but there are many ways that that through discrimination, without saying that it is, it can put people behind, and it can come from. This is something that happened to the Italians when they came to New York. Italian migrating to the United States, they go to New York and they were treated like dirt, and they were also, then the majority of the people, you never want to follow the crowd. And the reason is that 90% of the people is doing the wrong thing, even without knowing. So if you follow the crowd, you're going to be a loser. You're going to be the other 10% that is getting ahead. So you got to transition from the 90% that don't know what they're doing to the 10% that they get ahead. And this is where it comes in that you got a 90% gap. You got people making salary. You got people, there are 125 million families on this country, which is made out of 90%, that the average salary is 31,000. And there's 100 of 1%, 100th of 1% on this country, 25 families that made more than $2 million a day. So it goes a long way from some guy that made $2 million a day to a guy that barely making $15, $12 an hour. He cannot get ahead. So we got a 10% that fall in that branch. To qualify for the 10%, it don't take much. If you fall making $130,000 a year, you are part of the 10%. You're not part of the one, but you are above the other one, because below that 10%, there are 125,000 families, 125 million. 1/3, 90% of the families that work on this country, the average salary is $31,000 a year. And then you got guys that are making $2 million an hour, so you know who's making the money. And then they use the money to pass law to control the way that the laws are going to be done. And of course, you're going to be tilted in your favor, and not for the working guy.
Well, that's for sure. Well, I have to tell you, this has been a very fascinating, eye-opening experience about investing and trading stocks.
Thank you, thank you. That's right.
And we are running short of time, so we have time for just one more question. And our last question for today is asking, what is your biggest fear of the investment market industry?
Well, the biggest fear is the unknown. We think we have seen everything, and there's always something come up that we didn't thought about it. You can have act of God that can affect many people. Lately, everything was going good. The stock market going to 30,000, 36,000 points, and then somehow some Chinese virus comes around and shut down all the economies around the world. Nobody ever thought about that. And what can happen is that market crash, and if you don't get out, you could lose 50% of what you had. You know, it happened in 2008, but now we had the government comes in and shut down all the businesses. You have to stay home, don't do this. And now we create all kind of shortages, and everything costs more. So this is something that was unexpected. And there's always that in there. So I was very careful when I buy a stock and invest, that I don't want to wake up in the morning and find out that my money disappeared because something that nobody expected happened. And it's very possible.
Well, and especially with times like these, we are learning that unexpected things are actually beginning to occur.
Well, nobody has all the answers.
That's right. That's right.
No, they don't.
Well, Mr. Idrach, it has been a pleasure interviewing
Thank you.
you and for you to share your expertise with our audience regarding stocks and investments. Do you have anything else that you would like to say to our audience or to our viewers?
Well, I would like to say that education is very important. You know, follow education because it's a way for you to get ahead and study and look at the things and never give up. Because I started washing dishes for 25 cents an hour. Then I became a mechanic, and here I am now with a private mutual fund. And I dropped out of high school and I dropped out of college. So you keep on working on it and learning. Learning is very important.
Thank you for sharing those words of wisdom, Mr. Idrach, and thank you to our audience for also
Thank you.
sending in those questions to Mr. Idrach to answer. We have definitely gained a lot of valuable information about how to properly invest.
Mhm.
So thank you so much for sharing your 48 plus years of experience in the stock markets, and allowing the viewers to learn from your experiences.
Thank you. We appreciate it.
Thank you.
Thank you very much for
Appreciate it.
having me here. Thank you.